Hello, I'm Ryan McEachern, and welcome back to MSTA Canada's The Dig. It's my pleasure to have returning guest Peter Hall, who makes economics interesting. We'll be talking about inflation versus recession. Where is it headed? The Canadian dollar, is it strengthening or weakening? And global supply chains, are they broken or on the mend? But first, here's Brian with this week's 6 and 60.
Thank you very much, Ryan. Now let's get to it. The U.S. is targeting Russian metals and minerals as part of a broader package of new sanctions and tariffs a year after the invasion of Ukraine. This includes doubling tariffs to 70% on most metal and metal products. Victoria Gold Corp agreed to acquire ATAC Resources Limited for $16.4 million. ATAC Resources owns the Rakla gold property in Canada's Yukon Territory. The EU is working on a regulation to boost supply chain transparency, and trade groups in the US and Europe are discussing ways to collaborate on the issue. Russia's fertilizer exports have rebounded since its invasion of Ukraine. However, the country's expansion plans have been disrupted, and customers are looking to other potash producers to diversify their supply chains. Ukraine wants to boost graphite output and start exploiting its many copper and lithium deposits. And finally, Ryan, Mexico's president has signed a decree giving the energy ministry responsibility over the country's lithium reserves following the nationalization of lithium deposits in April of 2022. And that is your 6 and 60. And now here's our exclusive interview with Ryan and Peter Hall.
Hello, Peter. Welcome back to The Dig.
Hey, it's great to be back with you, Ryan.
Excellent. Well, the last time we talked, you were wearing a different hat. You were the chief economist for EDC, and now you're on your own. What's that all about?
Well, look, the EDC job is a great one. I had a wonderful ride there, was very well treated by the organization, and it was an intense job as well. And I thought, a great time for somebody younger with a lot of energy that they could throw at this. And of course, a lot of change coming our way as well. So somebody who's been working with me for a long, long time was given that task, that honor. And now I'm running a boutique strategy firm doing pretty much the same thing as I was doing for EDC, working together with senior executive teams, boards of directors on the future. What is going on? How can we actually anticipate what's coming our way? And what are some of the great ideas that we can leverage based on what the future is looking like? So I'm having a ball doing this, and it's wonderful to reconnect again with you, Ryan. I'm sure that you've got lots of questions about the future of MSTA, the mining sector inside of Canada, the broader world economy, and so forth. I'm still doing a forecast. I'm still keeping my eye on what it is that's going on out there. I'm still doing a fair amount of writing, and so happy to share with you some of the things that I'm seeing.
Excellent. And to that point, I have seen some of your, I guess they'd be op-eds in the Financial Post, and so always good to hear your perspective. And with that, I think it's a great segue. Why don't we kick it off with that first kind of topic, inflation versus recession? What are we in now, and where are we heading?
Well, one of the great surprises of the last year and a half is the onset of inflation. I mean, you got something that hasn't existed for all intents and purposes for 31 years. It's a monstrous shock when all of a sudden we seem to be back to the 1970s. And there aren't a whole lot of people around, like maybe you and me, that remember that time. And, I'll say for my part, I wasn't through my education at that point. I can remember in grade school, talking with my contemporaries there about running out of oil and skyrocketing prices. And as a kid, actually being quite transfixed by the whole thing. Plus, that's an awful long time ago. And there's a lot of collective memory loss about what the dynamics of that really are. So, here it washes right in. And of course, everybody was saying, look, we've had 31 years of stability. I don't think this thing is going to tick up into anything more than a temporary phenomenon. And now, of course, there's a lot of backpedaling on that particular view. How can inflation, being absent for so long, all of a sudden be something that we're having a hard time wresting back to the ground again? And so how do you deal with that? Well, there's a great central bank playbook for that. and it's called interest rate hikes. It's called lowering the amount of liquidity inside of the economy. And it's worked every time it's ever been used in history. So that's a great track record. And of course, there's been some recent experience with that. Recent, I mean, the last couple of generations have seen the effectiveness of this. So in my mind, there's no doubt about the fact that the central banks are going to win this one. Inflation is going to be gone. The big question is, okay, what's the fallout going to be? What's the fallout going to be around the world? Because it's not just the Bank of Canada that's doing this. It's the Fed south of the border. It's the European Central Bank. It's the Bank of England. You're covering a vast swath of the global economy that's actually into monetary tightening. And so that's the real issue. What is the impact of all of these interest rate increases really going to be on the economy? And let's remember, we have become inured. It's just sort of in our DNA now that low interest rates are de jour. And so everybody sort of seems to have calibrated their thinking around that. I don't want to pay 6, 7, 8% for a mortgage. I mean, what on earth? Like, give me my 2.5%. That's what I sort of aligned my life to right now. And of course, businesses have to lend as well. And this is a massive adjustment that's still ongoing. Remember, Ryan, it takes somewhere between 12 and 24 months for interest rate increases to have their full effect on the economy. And that's because not everybody's at variable rate. Lots of people have locked in mortgages, and those resets actually happen. Now, this is turning into a very lengthy answer, but not an easy question to deal with. That's the dynamic, the onset of inflation, the medicine for inflation, and then the impact on the economy. And so it's impact on the economy that everybody's really transfixed by. Anybody who's saying right now, by the way, okay, well, I guess we've got those interest rate increases in the economy now. Thank goodness that's over. Everybody says we're flattening out. And it's like, no. The train has left the station. It hasn't quite got to our crossing yet. It's still coming. And that's the thing that we need to brace for.
Right. Okay. Well, that's a great way to kind of put a box around it, if you will. And it's really kind of, where is it going? Because that's the concern I hear and read about is, are we creating a cliff, or is this kind of a low altitude soft landing that allows us to kind of deflate that balloon a bit and keep going? But it doesn't mean prices are going down as well, right? So I guess this is the time tested question that everybody's trying to watch and predict.
Well, if the prices did start to head down, there would be a lot of relief. Oh, goodness, I can go back to the grocery store and, peanuts cost what they used to, which isn't peanuts. And, everything else that goes into our regular basket of things that we purchase. Well, if central banks were to achieve that, that would take some either disinflation or deflation to achieve. And that's a very dangerous place to get to, because of course we would all like prices to go back to the trend level that they were rising at before. But how do you stop that kind of price reduction when it's set into the system? That's the kind of thing that is evidence of something more serious in the economy that's going on. Remember, when prices go down, when prices are going up, everybody wants to purchase ahead of time because they don't want to pay tomorrow's prices. They want to pay today's prices. Well, when prices are going down, you don't want to pay today's prices because you know that tomorrow everything's going to be cheaper. So all of a sudden we start deferring purchases. It's not just the bananas, that we're going to put off for another couple of days or whatever. I mean, these are essentials that we have to purchase. So what about the fridges, the stoves, the washers, the dryers, the roof repairs, and all that kind of big stuff, right, that we have to do that is like, oh, okay, well, maybe I can actually put that on for 6 more months. And if everybody across the economy decides to do that because prices are going down, then we got a big problem on our hands. So that's the tricky thing. Prices go up to a new level. And what we're trying to do is, okay, let's just get the increases down to 2%. Increases down to 2%. I'm paying 8% more for everything. And now you're going to layer on 2% on top of that. Well, that's to keep the economy stable. And it's not, it's not popular stuff to say, but, those are the dynamics. That's the danger of all of this. Now, the second thing that you mentioned there is recession. Like, are we going to have, light touch? Are we going to have heavy touch? what's actually going to happen? Well, that's a delicate question because we have had a monstrous increase in interest rates. The levels, people that were dealing with past, interest rate cycles would look at this one and just sort of say, well, that's a bit of a joke. Like, I remember paying 22% for a mortgage and so forth. That's serious stuff. But when you're paying close to zero and then you have this kind of increase actually happen, look at the percentage increase in interest rates, and it's like, wow, that's pretty substantial. And then look at, what kinds of debts people have taken on. And in Canada, our debt levels have soared over the last decade. It's frightening just to think of what our debt levels are at. So that, together with interest rate increases, is really going to put the bite on the economy. But the question of the kind of recession that you're going to have is really all about what kind of economy did you have before all of this started to happen? Well, stateside, they were very balanced. In fact, they got a lot of pent-up demand south of the border. So I think they're in for a light touch recession. However, we in Canada have a housing bubble, we have a debt bubble, and that covers, somewhere between 60 and 70% of our economy. And so our domestic economy is actually fundamentally weak. So the impact of the same kinds of interest rates on our two separate economies are quite different as far as I'm concerned. So it's going to be light touch in the United States. It's going to be something more severe in Canada here. And I don't take any pleasure in saying that. I just am trying to give the best advice that I possibly can. Now, for everybody in Canada who's an exporter, and I think that that's most of your customers, well, that's a good thing, because even if you're not a direct exporter, but you're servicing an industry that is heavily export oriented, if the economies outside of Canada are going to be much stronger, well, you get off the hook. You've actually got a stable, a strong market to actually sell into. Right.
Well, and so you kind of bring in this, across the border nuances and differences, and it's not isolated to just Canada on a whole, which is a nice way for us to kind of talk about exchange rates, because we just kind of saw recently with both sides kind of doing something different and watching our Canadian dollar kind of take a bit of a hit on that change. So where do you see our Canadian dollar and all this maybe heading forward as well?
It's a great question. And, in order to answer it, there are basically the drivers of the Canadian dollar that we need to talk about. So what historically has really driven the Canadian dollar? Number one, energy costs. And so the price of oil and gas. Number two, all other commodities. And so mining fits into that, forestry fits into that, agricultural products, and a whole host of other things. And the Bank of Canada tracks both of those things, the energy prices and then the non-energy bucket as well. And so we use those time series to sort of calibrate things. And, in terms of how world commodity prices are going, well, if large driver economies in the world are actually fundamentally strong, is what I would argue, well, those prices are going to remain stable as we go forward. I don't think there's going to be huge increases in those prices. And definitely as sort of the supply chain mayhem settles down, there's going to be more stability there. But, the risk would be on the high side. And so the prices of base metals, have a lot of prospect for remaining high, just given demand conditions around the world. A third element, though, is the difference between Canadian and U.S. interest rates. And here's the trick. If the U.S. is actually a balanced economy and they've got their interest rates back roughly in the area where they would be called neutral, then there's no reason for them to move back down. However, you have a severe recession that's brought on by the kind of interest rates that we see here in Canada, then we could actually see a bit of differential policy between the US and Canada. If that's the case, every 100 basis point wedge that opens up between our short-term interest rates, Canada versus the US, is actually worth somewhere around 3 cents on the dollar. Wow. And so that can be quite a significant movement. Now, I'll caution everybody, don't day trade based on that. It takes a while for that to actually seep into currency movements. It can take up to 18 months for that to actually occur. Two other things. One, Canada had this halo effect, when our fiscal policy was the best in the developed world, when our banking system was sort of venerated as being the strongest around there. And of course, that was a post-global financial crisis kind of thing. We still have very well-managed banks in Canada, but they're very domestically oriented. So if we have a recession, there's blowback on them. So that sort of Canadian halo effect has dimmed quite a bit, and that could suppress the currency. And then the final thing is, of course, the U.S. currency has been riding high against everybody's currency out there, and that's what happens during risky times. A lot of people actually go into the U.S. currency, and of course, it buttresses its level, and that's what we've been sort of on the flip side of over the last while. If you talk about the Canadian dollar being weak, so I put all that together, and I think that we're actually going to see a Canadian dollar that slips into the 65 to 69 cent US level over the next 12 to 18 months. And in fact, we could be there as soon as the end of this year, just given the timing of interest rate increases and their impact on the economy.
Right. So as you say, good if you're exporting, but if you're importing, it's something to consider and watch closely, I guess.
Well, if you like, yeah, it's something that could actually frustrate the efforts to moderate prices. If the currency is weaker, obviously, there's an inflationary impact on the imports that are coming in. Yeah.
Yeah. Right. Okay, let's switch now to the supply chain. There's been these trends. One, is it broken or is it on the mend? We can maybe address that, and soon after that, we'll dig into the concept of, is globalization over? Is friendshoring the only way to go? And we'll get into that. But first, let's talk about maybe the supply chain as a whole. Do you see it? Do you see it on the mend, Peter?
Yes, I actually do. But I've got to qualify that. The difficulties that we've had globally with supply chains actually date back to 2009. And that sort of shocks a lot of people when I try to date it back to then. But that was when globalization's first challenge really set in. There's been a long period of believing in globalization, banging on that drum, and leveraging the great advantages and efficiencies that you get out of globalization. Well, what happened then? Well, the world economy was taking a very severe belly landing, and countries all over the place were stimulating in great numbers and also in very radical amounts. And what happened at that point was some of the greatest proponents of globalization all of a sudden became very protectionist, because they're spilling all of this money out into their economy, but they know full well that in a globalized economy, other economies are going to benefit from their domestic stimulus. And so they started saying, well, how do we put walls around our money so that it's not leaking out of our economy to all of these other places? Well, technically, if everybody is stimulating at the same pace out there, then, just let globalization work, because it'll all operate as a regular economy would actually do. And what we lose to a particular place, we're going to gain back from them or somebody else, and everything's going to be fine. The difficulty is that each country had a different fiscal policy. This is the extent to which we're going to stimulate. Well, we're going to stimulate to this over. Okay, well, we want to keep all of that inside. And China, which is arguably the country that benefited the most from globalization, it got protectionist with its stimulus as well, because, its stimulus package as a share of its own GDP was maybe 3 to 4 times the amount of stimulus that we were seeing in our economies. Well, that's pretty substantial, and that was quite a radical change. So, that was sort of maybe the ignition point for a more protectionist stance. Now, globalization wasn't over then, but we had a long period of very meager growth. And of course, that didn't do anything to make anybody less protectionist. Then COVID comes along, and it's like, I'm tired of tsunamis and earthquakes and climate effects on the economy and pandemics and so forth, interrupting this beautiful just in time global system that we've actually got here. I've had it, I'm going to go back to nearshoring, reshoring, continentalizing my supply chains and so forth. Well, when SARS-1 occurred, we heard all the same tunes. Everybody said, oh, the world is never going to be the same. I'm never going to get on an airplane with anybody else. I'm never going to sit in an elevator. I don't want to go back to an office tower and so forth. And we almost had to remind people that SARS-1 happened when the pandemic actually hit, because everybody forgot all of this discourse. So we hear it all again, but this time it's way more entrenched. It was a much more severe event, very psychologically etched on our minds, and it's probably in our DNA now. And so this time around, is it actually occurring? Well, it's hard to say, because some people would say, okay, well, given even the rhetoric, globalization is over. Well, if you peel the rhetoric away and you look at the actual trade numbers, globalization is not over by any stretch of the imagination. And maybe it's not politically correct to say something as bold as that, because the perception in everybody's mind is that, there is a sort of death knell sounding for globalization. And I just don't see things that way. I think that certain industries are saying, well, look, we've got to make things where we sell them. But that argument, if you take it to its logical conclusion, would also say, well, look, the preponderance of growth in the market is going to be in these fast growing emerging markets, which are now about 50% of global GDP with a faster rate of growth. And so if you're going to build where you sell, the tables are turning so that you're going to be selling more. If you're doing things right, you're going to be selling more in those large, fast-growing emerging markets, which have lots of growth potential for many, many years to come. And so it is really decision point, but I think that globalization is a bit of an inevitability. And those who decide they're going to opt out of it are actually making a decision not to participate in the most dynamic growth areas of the world. Geopolitics makes that difficult. I get it, but the demand isn't going away. So it's not as if we can just say, okay, we're not going to deal with, countries of a particular type. We're going to rule them out. We're going to, put up sanctions or whatever against different kinds of behaviors and so forth. And I'm not saying I oppose dealing with particular regimes in that way, but the demand is still there. And somebody is going to be servicing that demand. And so whether you're actually servicing it yourself or selling to other places that are desperately trying to cope with the demand pressures in the world, somebody, for example, let's say Brazil says, okay, we're going to shift our resources and we're going to focus on the Chinese market. Well, what about all those other places you were just selling to? Yeah. Well, we can't deal with that anymore because, there ain't enough stuff. But we're just going to focus on the Chinese market. Okay, well, all these customers that you're ignoring are a potential market then, for somebody to actually go for. So there's more than one way to actually design business. I just would like that to be more a part of the discourse as opposed to sort of just throwing our hands up and saying, okay, that globalization thing that we were experimenting with is over. It is not over by any stretch of the imagination. And there's some very key Western world businesses that don't have a business model without the likes of China or Southeast Asia or India embedded into them. It's part of the fabric of their business plan, and so we need to realize that, and we need to calibrate our business accordingly.
Yeah, and I think of it as extremes, right? And just we're not swinging this full pendulum over to regional trade routes and supply chains, because to your point, it's just globalization is not going away, but it's about I guess a balance to that, understanding there's some other elements of risk that might be worth considering and adjusting how you view things. I see, from our world, from the mining perspective, the decarbonization, energy transition trends, critical minerals, I see this isn't a demand issue, it's a supply issue, and the pie is just going to actually enlarge. So, but cutting out the rest of the world, a big chunk of it to not take advantage of that demand or supplying it, it just wouldn't make business sense. So yeah, I think we're going to be, there's always going to be in the middle there of some sort. It comes down to, I guess, that's, I won't say security, but a certainty to it, and we're just shaking that out, I guess, as we go.
Mm-hmm. Well, it boils down to a fundamental question, and this is economics 100 stuff. Almost, when you just darken the door of an economics university class, you get the demand versus supply, and it's as basic as that. There is a global demand function. Demand is at a particular level. It's growing at a particular pace, and business has, from time immemorial, been about trying to satisfy those needs. The needs are out there. That's what drives things. It's not due to our own benevolence that we actually do that. And I'm quoting Adam Smith there. Goodness, I'm going back to 1776 for this one. But it's that it's there, and somebody comes along and says, "Oh, okay, the demand is there. All right, how can we service this demand?" Well, some are talking as if we need to completely alter the way that we do things to deal only with our friends. Well, if we want to really talk about the growth prospects in the future of our greatest friends in the world, if you added all of those key centers up together, they are the slower growing parts of the world. They're the parts of the world that are fully developed and have very soft demographic fundamentals. That's us, that's the United States, that's Western Europe, that's pretty much all of the OECD nations. And so if that's the case, then there's this other world out there that is a fast growing part of the world. And of course, if you're servicing that, and if you're calibrating yourself for that, you're having to do some pretty radical things with your production systems and your supply chains, and the governance and the protection of those supply chains, and the research and development that's required for product development and process development. You miss out on all of that by not being a part of that game. And so there are bigger implications for actually not being a part of a broader global game that really aren't a part of the discourse right now. So are we going to fall behind, not just in terms of the market reach that we have, but the product capability and the next generations of goods and services that are going to be required for our economy to function properly? I think there's some of those broader things that are important. When it comes to the mining industry, well, of course, yes, there is a real supply issue there. Thankfully, we sit inside of a geographic area where we have many of the resources that folks are looking for, but we've also got companies that are very good at finding those resources around the world and dealing with countries of all kinds in a very, in a friendly and a congenial way, with the kind of governance that, today requires. And so all of these are, if you like, sort of a Canadian comparative advantage. And it's becoming more important, and I've said maybe some things about globalization that aren't mainstream, but when you are sitting on resources that are politically safe, and we would call Canada very much a place like that. Mm-hmm. Well, that's now something that becomes very interesting to many in the world. Okay, yes, there are rich ore bodies in many parts of the world, but can we safely and reliably access those over time? And Canada's a place that you can come to and actually do that. So that becomes a bit of a selling feature in a world, in a market that we face today.
Right. Well, I think that's a great way to coin it. We could talk forever, I know, but I think let's end on that high note and in our sector's backyard as a topic. So, Peter, once again, real pleasure to have you on the dig, and look forward to having you again somewhere down the road, and we can have a look at this all over again.
Well, that'd be great, Ryan. I welcome that, and always happy to share thoughts with you. Good luck in all that you are doing, and very good luck to all of those who are your members as well. Exciting times, lots of good prospects for Canada. So all the best. We'll see you next time.
Excellent. Thanks a lot.
Pleasure.
And that's it for this episode. I want to thank Peter Hall for being a guest on our show again. If you haven't already, subscribe to our YouTube channel and LinkedIn, and follow us on Twitter at Mining Suppliers. Until next time, I'm Ryan McEachern. Take care and stay safe.